Afternoon. My name is Eugenie Birch, and I am the co-director of the Penn Institute for Urban Research with Susan Wachter. We're thrilled to welcome you to this Jeremy Nowak Memorial Lecture, co-hosted by Penn IUR and the Reinvestment Fund. This is the 5th year we've hosted the lecture in honor of Jeremy. As some of you may know, Jeremy was a tireless advocate who spent his career working to create equitable communities. We were honored to have him on our board here at Penn IUR and help continue his legacy each year with this memorial lecture. We hope you enjoy and learn from this year's lecture, centered on historic and contemporary issues impacting the flow of capital into and out of our neighborhoods. With that, I turn it over to Donald Hinkle Brown, President and CEO of the Reinvestment Fund.
Thanks, Jeannie. Welcome to our 5th conversation, inspired by and dedicated to Jeremy Nowak, a friend, professor, boss, organizer, visionary, comedian, and occasionally a clown, for those who knew him well. As we discuss capital flows today and responsible finance, please note that Jeremy's legacy is in part the strength we see today in the CDFI sector and reinvestment fund in particular. CDFIs are positioned today as implementers of positive social change and effective public policy initiatives, whether it is early childcare, food access, disability housing, small business finance, consumer credit, or so many other impactful areas. CDFIs are widely credited as the last mile connecting well-meaning mission capital to fulfilling connections in communities. On behalf of the Reinvestment Fund staff, our board, and our over 800 mission investors, welcome to an important panel discussion.
Good afternoon, everybody. Thanks, Jeannie and Don, for introducing us, get us kicked off. It's my honor to serve as moderator for this very meaningful annual event. We're here to celebrate the legacy of Jeremy Nowak, and because we're doing that, do what Jeremy would have required of us, to think deeply about the challenges we face and to confront and engage the long road, sadly long road, we still have to travel to create an equitable society. We're joined on this Zoom by many friends and colleagues of Jeremy, and I'd like to start by reading a brief note from Jeremy's daughter, Jessica, who regrets that she can't be here with us. So she wrote, "My family and I are so thankful that Penn and Reinvestment Fund continue to hold this event in honor of my dad, Jeremy Nowak. Special thank you to everyone involved today, especially Ira Goldstein for their dedication to my dad's legacy. This last month or so, I've had countless conversations in my own professional life about access to capital, particularly in the context of the Silicon Valley Bank run. I find myself talking to my dad in my head, imagining a lively banter, read argument, on how to break down the barrier of entry to new businesses and provide access to banking relationships without continuing the arguable fetishization of startups that occurred over the last decade. While those on this panel that knew my dad can attest to his ability to remain stubborn and steadfast in his positions, he loved to debate and secretly loved it when someone changed his mind. For that reason, I think he would be simply thrilled that a panel like this is put on his name. Thank you, Jessica Cohen Nowak." So thank you, Jessica, for those kind words. For myself, I met Jeremy 3 decades ago when I was a young lawyer working at Regional Housing Legal Services. RHLS continues to represent community-based organizations in the area and beyond, working with them to improve their communities through affordable housing and other kinds of equitable development. At the time, much of our work at RHLS was supported by the then named Delaware Valley Community Reinvestment Fund, which has since become Reinvestment Fund. I'm proud to serve today as a member of the board of directors of Reinvestment Fund and as a member of the Policy Advisory Committee. And I'm also proud to have been a friend of Jeremy's. I learned so much from him in many, many arguments over many decades, and his legacy is large. So we're together today to talk about the role of finance in promoting equitable communities, the core purpose of reinvestment fund. Unfortunately, historically and today, many financial institutions in this country have been engaged in inequitable financing, creating structures that enrich others and entrench and advance inequality. We'll be talking today about some of those inequitable structures and the important efforts of our panelists and others to combat them. And we will be returning to the core question for today. How can communities gain access and leverage good capital, good investment, investment that supports communities and enables everyone within them to flourish? You all understand the impact that redlining and other kinds of historical racial discrimination have had on opportunities in urban areas, and how decisions made generations ago have been amplified over the decades, resulting in substandard housing and deteriorating infrastructure. While cities have experienced unprecedented investment in recent years, at least compared to the second half of the 20th century, not enough of that investment has been targeted at historically marginalized communities. Many investments have also impacted neighborhoods through rising housing prices that imperil affordability in those areas. You also understand how lack of capital in rural areas prevents flourishing there. Over the past decades, initiatives such as the Community Reinvestment Act and the Community Development Financial Institutions Act have provided much needed investments in our communities. But in all cities, marginalized communities continue to struggle to access the resources necessary to grow. At the same time, communities must still combat predatory financial structures. It seems like there's a new model every year that extract resources instead of adding them. Our panelists today are doing the work of promoting good investment while preventing bad investment, and I'll introduce them now. So we're fortunate to be joined by three leaders working to promote equitable finance. Each has a long history of work in the areas of housing. I'll introduce each briefly and then ask them to discuss their work. Jillian White is the founder and head of White Picket Fence Appraisals. Motivated by her experience as one of the industry's few Black female appraisers and having to whitewash her own family's home in order to facilitate a sale, Jillian has made it her personal mission to educate and empower all homeowners. Curry Smith is Senior Staff Attorney in the Home Ownership and Consumer Rights Unit at Community Legal Services of Philadelphia, where she represents low-income consumers victimized by abusive, unfair, or predatory practices and homeowners facing foreclosure. George Mack McCarthy is the president and CEO of the Lincoln Institute for Land Policy, where he promotes the Institute's mission of improving the quality of life through the effective use of taxation, taxation, and stewardship of land. So we're going to start with Ms. White. So recently, people have come to recognize the important role that appraisal plays in getting capital into communities. Jillian will speak for a moment or two on the import of the appraisal in the process of bringing capital to communities, a little appraisal 101 for those not steeped in the process. So, for example, I hope that Ms. White, you can talk a little bit about how does the appraisal impact the flow of capital into communities and how it can adversely impact the degree to which wealth generation can occur, especially in communities of color. And also what some of your thoughts for an evolution of the appraisal could be so that it could be a more constructive tool. So welcome, Ms. White.
Thank you, Wendell. And hello to everybody who is tuning in. I'm going to share my screen, and then we can go ahead and get started. So once again, my name is Jillian White, and I am a real estate appraiser of 20 years. The first 13 years of my career, I was running my own appraisal company. And then for the next 6.5 years, I was a head of the appraisal department at a major bank. Very recently, I branched out on my own, creating Appraisal Insight, which is an educational company focused on educating non-appraisers about the appraisal process and procedures with a heavy emphasis on bias. I'm very excited to be here speaking at the Nowak Memorial Lecture. And while I never had the pleasure of meeting Jeremy, I like to think that we are kindred spirits, both fighting the good fight towards making a more equitable future. And so now I'm going to talk to you about how appraisals plays a role in creating that equitable future. To start, like Wendell said, I'd like to go over some basics regarding the appraisal process. Number one, who needs an appraisal? An appraisal typically is needed by anybody who doesn't have the cash on hand to purchase a property outright. What is an appraisal? The technical definition is an opinion of value. When can you get an appraisal? At any point in time. Where can you get an appraisal? Anywhere in the US, because the appraisal processes in other countries differ from our own. And why is the appraisal needed? The appraisal is there to protect the interests of the bank. And so a little bit more about that. The house is a form of collateral for the mortgage. And so in the event that the homeowner stops paying the mortgage, the bank wants to ensure that they can sell the property and hopefully recoup the amount of money that was loaned to the person who defaulted. And so really it's a financial a safeguard, so to speak, that is put into place. And so this pans out typically and most commonly in two ways. The first one being in refinance transactions, and the second one being in purchase transactions. With a refinance, the homeowner typically is looking to get into more favorable financial terms with the existing mortgage. And with a purchase, somebody is going and identifying a home that they want to buy and then starting the mortgage application process. Within refinances, there are two most common types. The first one being a rate and term refinance, where typically the interest rates of the mortgage get lowered, therefore the monthly mortgage payments are decreased as well. But then there's a second type of refinance, which is called a cash out refinance. And that is when the homeowners extract value from the home and put that money in their pockets and are able to invest it in their communities. And so for the purposes of this talk, I'm going to be heavily focused on refinance transactions and specifically how cash out refinance transactions tend to work. So let's start with a few examples. Imagine for a moment your own home. And your home, for most people, is the largest wealth vehicle. And so think of the wealth being locked up in the home, and there needs to be a key to unlock it. That appraisal is that key. So let's say your estimate of value is roughly $300,000. An appraisal is completed for a mortgage transaction, so you can take cash out, but it only comes in at $285,000. There's a good chance that in that scenario, you would not be able to extract value from your home. Another example, let's say the home is estimated to be worth about $215,000. So you get the key, the appraisal, to unlock that value. And let's say that appraised value comes in close at $210,000, but not right at the $215,000 mark. There's a chance that that homeowner will not be able to extract value. And then in this example, let's assume that the home is estimated to be worth roughly $500,000. The homeowners get the key, the appraisal. The appraisal comes in at $500,000. Now that homeowner is able to successfully extract wealth from their home and put that money in their pocket to be reinvested however they see fit. So I often get asked, what prevents the key from unlocking wealth? Or to put it another way, what prevents the appraisal from unlocking wealth? And there are a number of reasons, but one of the really big ones is discretion. Going back to what I said on the earlier slide, an appraisal is simply an opinion of value. And so the appraiser has a lot of discretion in things such as comparable selection. The way value is determined is that the appraiser will compare the house being appraised to other similar properties in the neighborhood that sold recently. It is at the appraiser's discretion to select these comparables. And so they can select comparables at the high end of the value range or at the low end of the value range. Another point of discretion are adjustments. When the appraiser is comparing the house being appraised to other properties in the neighborhood, it is rare that the two are identical. Therefore, the appraiser needs to make positive adjustments and negative adjustments in order to equalize the two properties. Once again, it is at the appraiser's discretion to determine what methodology they're going to use when making their adjustment and what specific numbers they're going to select when making their adjustments. And then a third area of discretion is in the reconciliation. So after the appraiser has selected the comparables and after the appraiser has made their adjustments, they are left with a value range. And so at their discretion to determine where within that value range they are going to appraise the home. So taking a look at how this actually plays out between appraisers, assume for a moment that one house is being appraised, but it's being appraised by two different people, appraiser A and by appraiser B. And let's assume for this example, all of the comparables at the top are the higher end properties, and all the comparables at the bottom are the lower end properties. So let's say appraiser A is of the opinion that the highest comps are the most appropriate for this property. But let's say appraiser B has a different opinion, and they believe that the low end comps are the most appropriate for this property. Then within this pool of value ranges, let's say appraiser A selects the first three comps and appraiser B selects the last three comps. So now you can see their values already just with a comp selection are diametrically opposed. Now let's say that appraiser A decides to make very minimal and small adjustments, whereas appraiser B chooses to make very large, sizable adjustments. Let's say appraiser A decides to reconcile their value at the high end of the value range, whereas appraiser B decides to reconcile their value at the low end of the value range. And so in this scenario, there's a chance that the appraisal from appraiser A might be successful in unlocking the wealth that is stored in the house that's being appraised, whereas appraiser B's appraisal might not be successful in unlocking the wealth that is stored. And so what happens is that this scenario plays out across neighborhoods over time. So there's certain neighborhoods where consistently the homeowners are able to get appraisals that unlock their wealth, and they have access to this capital, which they can reinvest in their communities. But on the flip side, there are communities that consistently are unable to access capital. And so the homeowners do not have access to wealth and are not able to reinvest in their communities in the same way. And so over the generations, what will happen is the communities that have access to this unlocking of wealth tend to increase or appreciate over time, whereas the communities that don't have access to this unlock tend to either stagnate or depreciate over time. And so now, in terms of what to be done about it and what is a possible solution, well, a good start is reducing the amount of discretion in the appraisal process. Because if you think about it, if the appraisal has the power to unlock wealth, which it does, then the appraised values need to be consistent. And so that concludes my remarks. Thank you so much for your time and attention. And if you're interested in finding out more about this topic, please visit my website at www.jillian-white.com. Thank you.
Thank you, Jillian, for that very clear introduction to a very opaque process that many of us have participated in, but never have fully understood. So I greatly appreciate that. I want to bring in Mac and Curry, but I hope that we will return to dig in a little bit more deeply about how the appraisal process and appraisals can help communities flourish, because I do think that's one of the many tools that we have to do that. But let's bring in Mac now. So Mac, we already had an introduction by Don, who leads a CDFI, but we'd love it if you could educate us a little bit more about CDFIs. As you know, they play an important role in bringing capital to communities, and I hope you could talk a little bit about how CDFIs bring what you've called smart subsidy, or Jeremy has called smart subsidy. In other words, capital that brings forth more good capital. And also, if you could talk to us a little bit about how do you think supporting the community infrastructure, we can do that so that capital can have positive desired impacts.
Sure, and thanks, and really thank you for this invitation. I was a huge fan of Jeremy and Jeremy's work, and I had the immense privilege to travel all over the world with Jeremy as part of the work I was doing at the Ford Foundation in development finance, and it was just a pleasure to be in his company. So, you know, when we think about defects in markets, right, and like the appraisal bias that we were just talking about, what Jillian was just talking about, there's, you know, a whole bunch of structurally racist practices like housing discrimination, steering, and even predatory lending that we look at as really deleterious to communities and especially to the people living in those communities. And when we encounter them, we often jump to sometimes what we consider to be the simplest remedies. And that's usually, you know, regulation and enforcement. And sometimes it's direct intervention in markets to make the markets work. But, you know, one of the biggest kind of more challenging questions for us is, how do we get from detecting market failures to successful remedies? And the second question is, who's in a position to shepherd that process of detecting the market failures and then getting to those remedies? Another question is, how do we get from, you know, system failure to systemic solution? And a third question is, how do we know how and when the system is actually working, right? So as it turns out, you know, all that really begins with systems thinking and system thinkers like Jeremy. And, you know, we all know that, you know, in the history of the United States in particular, we eviscerated inner city neighborhoods and we punished minority populations for decades after the Great Depression by distorting markets with structurally racist practices. Racial and ethnic discrimination wasn't invented in the 1930s, but the Homeowner Loan Corporation and the FHA, for a couple of examples, institutionalized the bias and the hatred that already existed and made it standard practice for the rest of the market players, bankers, realtors, appraisers, assessors. And so once we institutionalized those market failures and we allowed the practices to run amok for decades, we created a cascading set of intended and unintended consequences that created a far more complex tapestry of challenges that we now face that are really a lot harder to solve. So, you know, I'm sorry to be such a, you know, broad historian, but when we started to address racial discrimination in housing finance markets, we started in the 1960s with the Civil Rights Act in 1964, the Fair Housing Act in 1969, HMDA in 1975, the CRA in 1977. And yet somehow the racial homeownership gap in the United States today is worse than it was in 1960, before all those policy efforts to actually redress the problem that we all saw and knew was there, right? So even though we've actively been trying to eradicate discrimination in housing markets and housing finance markets, we've already seen, as Jillian points out, a systemic failure if we're getting appraisals wrong and not allowing people to unlock the assets they have in their neighborhoods. But the problem with appraisal bias actually was even worse in the 1930s, 40s, and 50s, when we were actually not allowing people to get mortgages to buy homes in certain neighborhoods because of their ethnic or racial composition. And that was created by the Homeowner Loan Corporation, where they went around the country and created these secret maps by working with realtors and bankers and others, you know, real estate professionals in local markets to decide where and when they would lend to really address at the time, the biggest housing collapse in the history of housing collapses until 2008. And you know, as it turns out, those maps now really still define the way we organize ourselves in cities, and they tell us pretty much, you know, since the 1930s, where the most troubling neighborhoods are in cities. And every time we try to address those kinds of remedies, we usually come up with kind of these simple-minded approaches that don't appreciate the complexity of the markets and the systems and the complex ways that systemic racism actually metastasizes in the markets like a cancer. And, you know, just to put it more simply, if you think about it this way, if we deny access to capital for communities and ethnic groups long enough, simply offering them access to capital is not a sufficient remedy, right? And the way I like to think about it is, if you starve a garden of water long enough, simply bringing water back to the garden is not going to produce fruits and vegetables for you. And so one of the things that we've needed to figure out then is not just how to get capital into markets, but what other things are needed to make bringing capital to local communities work. What does it take to make those communities actually succeed? And so if you ask Jeremy, he would suggest at least three things, right? And one of them is kind of the right institutional structure that's going to be there to help build the capacity to use the capital once it's available and to deploy it intelligently. And one of the things that we have to recognize is if you remove capital from a community for generations, then when you bring the capital back, you're not going to have people that are there ready to deploy the capital and make the intelligent investments that are going to make that community thrive. But you're also going to need other things. You're going to need analytic tools to track the progress of what you're doing, and also to learn from your own mistakes and to course correct, right? Because one of the things about intervention in complex systems is it's not a one-shot deal. You have to experiment with what's going to work, what's not going to work, and you adjust as you go along. And the market itself adjusts as well. And so sometimes you have to catch up to the new way that people and players are behaving in the market. And then you need smart subsidy, right? And as far as Jeremy was concerned, and I agree with him wholeheartedly, just throwing subsidy at any kind of market problem isn't going to work unless the subsidy is deployed in really intelligent ways, in time-limited ways that make financial interventions that recalibrate the market behavior and reset it to behave on its own in the way you want it to behave. So Jeremy coined that term, smart subsidy, in a paper that we helped him publish when I was at Ford in 2003, when he was working with us on, as I mentioned, traveling all over the world on development finance. He was a member of what we call the International Leaders Forum. And these were development finance experts from all over the world who got together to just share what they were learning in their own countries and then help to kind of cross-pollinize practices and ideas and get different things working in different places. But after Jeremy published that paper, it spawned a small library of scholarship that includes at least a couple of additional papers that Jeremy published in 2012 and 2013. One of them as part of a volume from a conference that Penn and the Philadelphia Fed hosted, and another as published by the Living Cities. But what he did was he imagined that these three elements kind of would work together. And so you would have kind of an institution that could be the bridge for outside capital back into communities that have been starved for capital and help that community to identify and cultivate investable deals and then make the investments that are going to be necessary for those deals to happen, right? But then also to track those investments and also track the success of other things, the regulations, the policies we put in place to make sure that the flow of capital is actually working in the right way, and finding ways to facilitate more equitable and inclusive economies in the process. And then he would unleash these new analytic capacities, within that institution to do that tracking. And so when it all came down to it, what Jeremy figured out was that you could kind of bundle into one institution all of the elements you need to kind of make kind of a community, find a new kind of economic trajectory that is both equitable and inclusive. And that institution was actually the reinvestment fund. The reinvestment fund didn't just bring capital, but it brought technical assistance, expertise. It found ways to be able to cultivate new investable deals and then help shepherd those deals to success, right? But it also built analytic capacity through people like Ira Goldstein and also through things like Policy Map, which is able to then kind of document and provide the background for data-driven decisions that are going to make us work better. And then he advocated very strongly for smart subsidies, making sure that we had these time-limited financial interventions that were going to reset the incentives in the local markets to make sure that all of the players were going to be, incentivized to behave correctly and then become kind of naturally and organically kind of successful and supportive of the community. And so, since Jeremy's passing and really, since the time that I spent with him before, I've spent a lot of time thinking about why it is that there are so few other organizations like the Reinvestment Fund in the world. And I have to conclude that I think it's because there are so few Jeremy Nowaks in the world with the vision and the drive and the ability to kind of make those key institutional players happen that are going to make and help make places work and do it in the long run with the kind of commitment and the kind of intelligence and the kind of drive that Jeremy brought there. So I'll just end there. I think that I think you all know just how important the Reinvestment Fund is for Philadelphia, and I think that we all also appreciate just how important and critical Jeremy Nowak was to bringing that about. So thank you for your kind attention.
Thank you, Mac. I hope one of the many things we can come back to is how do we create more leaders in this field? And I would welcome suggestions from our audience about that question. And I also mentioned, as we've seen in the chat, our colleague Ira Goldstein is going to be taking questions from the chat and putting them together to facilitate further conversation among the four of us. So please do put any questions that you have for any of the panelists in the chat. And now let's turn to Curry Smith. So Curry, recognizing that all the hard work and legal battles fought over the years and many successes, no matter what it seems like, there are always people who are actively trying to undo hard-fought gains, and you've been involved in lots of these efforts. One such example today is a firm called MV Realty, and I want to invite you to talk a little bit about MV Realty's abusive processes, who and what communities are impacted disproportionately, and what a collection of people from various parts of the community and government and other sectors have done to bring these bad actors to a halt.
Great, thank you, Wendell. Let me take a moment to share my screen. Is that working can everyone see my screen?
Yes.
Great. Well, I really appreciate the opportunity to join the conversation today to talk about how we can build a more equitable future. And I think it involves both increasing access to capital, but also, as you said, ensuring that predatory practices don't erode any of the gains that we've made. And that second component is so critical because financial predators are so creative at developing new schemes designed to extract the wealth and equity that people have worked so hard to build. I know that Jeremy and the Reinvestment Fund have made just extraordinary contributions on both fronts. I joined Community Legal Services as a new attorney in 2005 at the height of the subprime mortgage crisis. And I was just immediately struck by how much we relied on the Reinvestment Fund to support the work that we were doing on behalf of our low-income clients. It was really the first to provide the data to quantify the impact of predatory lending. And it's done the same with predatory reverse mortgage loans, abusive debt collection practices in our courts, and really, there's been no shortage of predatory actors. And today I'm going to share with you an example of a contemporary wealth extractor, MV Realty, and how the Philadelphia community, including CLS and the Reinvestment Fund, have come together working to bring those abusive practices to an end. So quick background on how CLS got involved. CLS provides free legal services to low-income Philadelphians on a range of civil matters, and we dedicate a lot of resources to saving and protecting low-income individuals and families, their homes. And last year, several homeowners sought legal help from CLS, believing that they had fallen victim to a deed theft scam. They had received a notice from the Philadelphia Department of Records, informing them that a document had been recorded against their property, and they feared that someone had created a fraudulent deed, transferring the ownership of their home. We investigated and we discovered a completely different kind of scam. A real estate company, MV Realty, was operating a predatory home equity stripping scheme, tricking homeowners into giving up thousands of dollars of their most valuable asset, their home. The company essentially promises homeowners just a few $100s of quick and easy cash, but then traps them into a mortgage through which they'll be paying thousands for any transfer of their home. Over their valuable asset over the next 40 years. The scheme is operating in 33 states and was flourishing here in Philadelphia, where the company recorded over 500 mortgages in the last 2 years, the vast majority of which are in Black and brown neighborhoods. Based on our clients' experiences, the mortgages are the result of unfair and deceptive trade practices. Much like the predatory lenders of the subprime mortgage crisis, MV Realty engages in aggressive and abusive tactics to extract the wealth that Philadelphians, especially Black and brown homeowners, have built through homeownership. Here's how the operation works. The MV Realty lures homeowners into the scheme with a promise of a small cash payment, typically $300 to $900, in exchange for agreeing to use MV Realty as a real estate agent should they choose to sell their home in the future. It is the emphasis in the sales pitch is that there's going to be no obligation to sell their home. So it sounds good. Get some cash up front, and if they sell their home, which they're under no obligation to do, they'll use MV Realty as their real estate agent. MV Realty then quickly sends a notary to the homeowner to sign the paperwork to finalize the deal. Typically, it's signed the same day or the next day. Consumers report being really rushed through. The terms of the contract are very complex, and they go well beyond simply having to use the company as a real estate agent. Certainly, MV Realty does get the right to serve as exclusive listing agent for the home for 40 years. They can get 6% of the sales price of the home or 3% of what MV Realty estimates to be the value of the home at the time the agreement was signed. So they're protected even if the home value declines. Sorry, next slide, please. In addition, MV Realty requires a homeowner to pay a fee for at least 3% of the home market value for any transfer of the property over the next 40 years. Next slide, please. Sorry, having technical issues here with the PowerPoint. We're on slide 7. So it requires homeowners to pay 3% of the home market value as determined by MV Realty for any transfer of the property during the next 40 years. They also require homeowners to sign a mortgage, putting up their home as a guarantee for any money that's due under the homeowner benefit agreement. And they record that mortgage as a lien against their property. And homeowners reported just that they were completely blindsided by this mortgage being recorded and included in the stack of documents that they were required to sign. And when they learned that the mortgage was included, they were shocked, angry, and they were really concerned about the impact of the mortgage on their homes. MV Realty did a great job of protecting itself from any liability. Not only is the contract substantively unfair, they also prohibit homeowners from engaging in class action lawsuits or suing them in court. But MV Realty reserved their rights to sue the homeowner in court, and in fact had done so. And you can understand why they're trying to insulate themselves from liability. Not only do they engage in unfair and deceptive trade practices, they're really in many ways engaging in illegal lending. This is really, while MV Realty markets these products as a loan alternative and claims they're not a loan, they really are a disguised loan, where MV Realty is essentially guaranteeing itself 10 times the amount of cash that they're giving the homeowner. When they enter into the contract with the homeowner, the MV Realty company estimates the value of the home. They guarantee themselves a commission of 3%. of the value of the home, and then give a payment to the homeowner of 10% of that guaranteed fee. So consider a home worth $150,000. They guarantee themselves a commission of $4,500 and give the homeowner $450 in cash. In loan terms, that's just carries an extraordinary interest rate, right? If a homeowner were to sell their home in 5 years, that would carry 180% APR. If they sell it in 1 year, it would be a 900% APR. So who's behind this? Wall Street. According to litigation documents filed from a federal lawsuit between MV Realty and an investment firm, Innovatus Capital Partners, the companies had planned to securitize these contracts, which totaled over $10,000 in 2019. And in the category of you just really can't make this up, one of the leaders of the scheme is Amanda Zankman, who was previously known as Amanda Zuckerman. She is one of the most notorious villains of the TV reality show Big Brother. Forbes did a great article cataloging all the investors in this scheme, and has a great link in their article to a set of clips from that show that just terribly overtly racist comments by the founder of this company. Which leads me to another way in which the home equity stripping scheme of MV Realty echoes what we saw during the predatory mortgage crisis, and that's who's being targeted by this product. Thanks to the reinvestment fund, we've been able to see exactly who's being targeted, and it's disproportionately impacting Black and brown homeowners in Philadelphia. Every green dot on this map of Philadelphia represents a recorded MV Realty mortgage. The map is shaded so that areas with darker shades of brown are neighborhoods with higher concentration of Black residents. And the cross-hatching are areas where there's a substantial Hispanic population. And I think the map really captures the undisputable concentration of MV recorded mortgages in the Black and Hispanic neighborhoods of Philadelphia. And it's not just disproportionality by neighborhoods, it's also disproportionality in the individual homeowners who are impacted. While we can't know with certainty, of course, the race and ethnicity of the homeowners, the reinvestment fund was able to use an algorithm used by the federal government and its civil rights examinations of financial institutions to estimate the race and ethnicity. And this chart shows the gray bar represents the percentage of homeowners in Philadelphia who are of a given race or ethnicity. So for example, you can see that Black homeowners make up 37% of homeowners in Philadelphia. The orange bar here reveals the percentage of MV Realty mortgages we estimate go to homeowners of that race. So in Philadelphia, Black homeowners make up 37% of homeowners, and they make up 69% of the Philadelphia homeowners with MV Realty mortgages. This really demonstrates that in addition to the unfair and deceptive trade practices of MV Realty, there also appears to be discriminatory practices that raise fair housing claims. To address these practices and these harms, a coalition, including government agencies, including the city administration, enforcement agencies like the Attorney General's office, nonprofits like CLS, housing counselors, the Reinvestment Fund, have all come together to develop a coordinated response. Because the company insulates itself from individual actions, we focused on encouraging the enforcement agencies to take swift action. We worked with City Council to hold hearings to bring attention to this issue, with victims speaking out about their experience, and Ira Goldstein and his team testifying about the disproportionality impact of the scheme. And we were very pleased on the morning of the hearing to learn that the Pennsylvania Attorney General's office filed a lawsuit against MV. And they're requesting restitution for all people who have suffered losses. They're demanding that the mortgage be stricken and the practice be stopped. The city of Philadelphia has also taken action to reach out to homeowners who were impacted. They mailed all 500 homeowners who have been impacted. They held a set of informational sessions connecting people with resources and tools for help for getting out of the predatory mortgage that they're trapped in. And we're also working on a legislative response. While we think their actions are illegal because they're unfair and deceptive and discriminatory, steps are being taken to ensure that this practice is just banned in Pennsylvania. There's a model bill drafted by the American Land Title Association that completely prohibits the practice. All across the country, bills are being filed. Colorado, I believe, is the first to actually pass the law, and there's pending legislation here. Some key takeaways. Predators are constantly creating these new schemes that are going to extract wealth from our communities, wealth that people have worked very hard to get to flow into our communities. And we need to take action to ensure that those assets are protected. I think one of the ways we can do that is make sure that we have robust consumer protection laws and also the will to enforce them. That's critical for ensuring that predatory practices don't erode any of those hard-fought gains. And of course, community engagement is key. Listening to people on the ground whose clients are experiencing the most recent predatory schemes and then being able to swiftly respond. Happy to answer any questions. Sorry for the technical difficulties with the PowerPoint in the beginning. I appreciate the opportunity to contribute today.
Thank you, Terry, for your presentation. More importantly, thank you for your work in protecting homeowners in this city and in other places. One of our many goals for this conversation was just consciousness raising about, again, the many ways that wealth is extracted from communities, and Carrie's good work and Jillian's good work, and of course, Mac's work in supporting positive investment, all are examples of that. But we want to make sure that everybody on this Zoom understands these kind of new approaches to extracting wealth, and Carrie was generous in sharing her email. I would sadly not be surprised if somebody on the Zoom even had some personal experience with this issue. So I want to go back to Jillian for a minute. Your presentation elicited a lot of questions from the audience, and I think I'll try to put them together by asking you to talk a little bit more about how you got engaged with this issue of appraisal bias, and maybe even giving us a little bit more about your personal experience. But then also, if you could please talk a little bit more about what you see as some of the solutions to decreasing in bias.
Wendell, okay, you froze for a second. So yeah. I heard part of the question about my experiences. And
then also, if you could talk a little bit more about some of the many efforts that you're doing to increase diversity in the field and decrease bias, please.
Sure. So starting with my involvement with this topic, for the first 10 years that I was appraising, I wasn't networking on a national level. So I actually didn't even recognize, and I am an anomaly among appraisers. 97% of appraisers are white, 70% are male. 2/3 of appraisers are at or near retirement age. And so it's only when I started going to national conferences and taking a look around, I was like, oh, okay, one of these things is not like the other. Then in 2020, when there's a first New York Times article regarding bias in appraising, where there was an interracial couple who had an appraisal completed. The first appraisal came in very low. So the bank ordered a second appraisal, and in preparation for the second appraisal, the couple whitewashed their home, and that appraised value came in much higher. That was really the first time that I got pulled into this conversation. And the reason why I got pulled into it is because at the bank, everyone was asking me, oh my goodness, this is happening. We can't believe it. What are we doing about it? But from my viewpoint, I was actually surprised that they didn't know that whitewashing was a practice, because I had whitewashed my parents' home. It was my recommendation in preparation for a sale. I was a listing agent, and I was like, hey, listen, I think this is what we need to do in order to ensure that it sells for the highest amount. And it's something that we never spoke about again. But for me, this was just part of the Black experience. And so it was only through seeing the whitewashing conversation through a different lens that I really came to terms with how ridiculous it is that there are families and whole communities that feel in order to get a fair shake in their real estate transaction, they have to pretend to be people that they are not. And so since there are so few Black appraisers, and the article was centering around the appraisal process specifically, I felt the need to lend my voice to the conversation and say, hey, I understand how it works from an appraisal standpoint. I understand how it works from a Black homeownership standpoint. And I also understand how it works from the lender's perspective as well. So, so that's been that's how I got involved in this conversation. And then in terms of the work that's being done to help solve for bias in appraising, the first thing is to recognize bias comes in many different forms. So there is the implicit bias, there is the explicit bias, and there is the structural bias. The bulk of the problem actually resides at the structural level with the aftermath of redlining, which I highlighted a bit in my presentation, how certain communities consistently have had access to capital, where certain communities have consistently not had access to capital. My presentations and my area that I talk about typically focuses on the implicit biases of appraisers. And so part of that is because the appraiser population is just so homogenous. Again, 97% white is the least diverse industry in all of the United States, according to the US Bureau of Labor Statistics. And so I think the very first step is just having an awareness that that there is an opportunity for biases, and then focusing very much on the areas of discretion, because that's where the individual biases of their appraisers is going to show up. And then moving towards something that is much more standardized, because the fact that somebody's wealth and their access to it can be determined by an opinion, and opinions vary greatly. It's just not robust enough for there to be so much weight placed on this number.
Thank you, Jillian. So there's a question in the chat for Curry that I want to go to next, but then I also want to give heads up to all three of the panelists. I'm hoping that we can put all four of us on the screen and we can have a conversation about some of the aspects of the challenge of finance that you think we should be focused on moving forward. But first, question for you, Curry. I'll read the specific question, then add an edit, or an amendment. The question is there a way that practices like those of MV Realty can be criminalized? That's the question. And I'll also invite you to reflect, given your many years of work in this area, of what do you think the role of government is in protecting homeowners and renters, and how might we restructure our systems so that these things don't happen in the future?
These are great questions. I mean, I think we all need to, it's now been well over a decade, but we all need to reflect on the lessons learned from the subprime mortgage crisis, right? When I joined CLS, as I mentioned when we first started the presentation, it kind of felt like groups were sort of screaming into the void. And it took a whole almost virtual global economic collapse to finally get attention to the subprime mortgage crisis. And I'm hopeful that hope that our government and institutions have learned an important lesson from that experience, and understand that we need robust consumer protections. And yes, sometimes we need to criminalize activity in addition to just going after civil penalties. And we need to make sure that we have consumer protections in place. And again, the political will to enforce those, to ensure that we're not, all the work that we're doing to invest capital in communities, that's all at risk if we don't have consumer protections in place to protect people from the predators who are kind of lying in wait with the new scheme to just extract and take that wealth.
Thank you, Curry. So I want to invite all three of the panelists to think about several questions that have been raised. I'll try to put them into one question. So going forward, as we talk about smart finance and equitable finance, what do all three of you think are the most important things that government and private institutions need to be doing to promote equitable finance that actually helps people within communities stay in their communities and grow and flourish? And that's a gigantic question, obviously, and there's many ways we could take it. But I'm really interested in some of your high-level thoughts about, from your perspectives, given what you do, about how can government institutions, how can institutions like the University of Pennsylvania facilitate good capital so that people can stay in their communities or move to the communities they want to be in and flourish.
So I'll jump in quickly. Wendell. So, one thing about helping communities to flourish, and I think this relates to the appraisal bias and also to asset stripping, is, it's defending the assets that are there, right? And so part of the defending the assets that are there is being able to kind of keep track of what's actually going on. And so that what's great is that, people like Harry are able to detect when MV Realty's showing up and trying to strip assets out of a community. But another thing that's been going on, legally at the hands of Wall Street is that institutional investors are now buying up the single family housing stock all over the country. And, on average, we're talking about, 15 to 20% of single family transactions that are taking place now are institutional investors buying owner occupied housing and converting it to rental housing. And the reason they're doing it is because rental markets have gotten so tight that rents are going up. And then what they're trying to do is, find ways to, in some cases, revalue the neighborhood by being able to extract rent out of it and raise the asset value of the neighborhood, but for the investors, not for the residents, right? And so there's a bunch of remedies to that, and one of the remedies would be kind of related to a remedy to what MV Realty is doing, which is for the public sector to start to buy or to acquire in one way or another a right of first refusal on properties to make sure they don't slip into institutional investors' hands, to make sure that those assets, the housing and other kind of real estate assets, are actually still held at least in some form of control of the community, right? And then it's promoting other kinds of community investments that will make the rest of the community prosper, whether it's maintaining permanently affordable housing in the form of community land trusts, improving green space, finding ways to accelerate the reuse of vacant and abandoned properties. All of those things, right, are ways that you not just defend the assets, but help to build and increase the value of the asset base that exists in the community now, and make sure that it happens without displacing the current residents. Because the dominant economic development models are all about bringing new people in and displacing the poor people. It's not about finding ways to make the lives of the people who live there better, right? And there's a bunch of interventions, but we have to kind of commit ourselves to saying, we succeed when we make the community that's there already better. And maybe that community will also then attract additional people, but as long as we're not displacing people, that's really a good thing. And in places like Cincinnati, the redevelopment authority, which there, oddly enough, is called the Port of Cincinnati, decided to get ahead of these institutional investors by buying the properties themselves, fixing them up and reselling them to low mod income families who can then become part of those neighborhoods, right? And there there's many other ways. I mean, there's more aggressive code enforcement. There's really the efforts to kind of police the other predatory practices that are going on. But we just have to commit ourselves to the defense first, and then the investment second, that is going to help to increase the value of those the assets in those communities.
Thank you, Mac. I want to invite Jillian and Curry to share some thoughts. I want to just preview that we have lots of questions in the chat, unsurprisingly, about the impact of gentrification. And I want to come back to that question more specifically about how do we use equitable finance to promote the right kinds of development and make sure that people are able to stay in their neighborhoods. But first, I'll turn it to Jillian on this first question.
Yeah, actually, Wendell, I think my answer also speaks to the second question as well. So George, during your presentation, you used an analogy that I absolutely love, the analogy of a garden. And if you stop watering the garden, there comes a point in time where just adding water isn't enough. If you want to, reap the benefits of that garden. And so the same thing is true specifically with appraising and appraisal bias. So again, I speak a lot to the implicit biases that are built in, but even if those were completely eradicated and every appraiser's opinions started matching up perfectly, there's still the inherent structural biases as a result of redlining. And so since very clear action was taken to prevent capital from flowing into those neighborhoods, then equally as specific action needs to be taken in terms of the reinvestment. And so something I've been hearing a lot about lately is a restorative valuation model within appraising, there's already lots of talk about something called automated valuation models, or AVMs. And AVMs are pretty much appraisals generated by machines. But the restorative valuation models, the RVMs, would also be generated by machines, but taking into account the suppression of property values in certain areas. And if they had not been suppressed, what would they be valued at today? And giving the owners in those properties access to that capital. Right now, in terms of getting financing for this restorative valuation model number versus the appraised value, that's been a bit tricky. And that's where CDFIs can really come in and help bridge that gap. And the idea being that there would be financial support for a time until these communities have the ability to catch up and then re-enter into the conventional lending pool.
Thank you, Jillian. Kari, again, somebody who's spent a lot of years thinking about how to protect these neighborhoods. So I'd love to hear your thoughts about how we can advance in a more equitable way our neighborhoods.
In addition to, my practice involves working to save low-income homeowners and preserve the homes that they're in. And I think homeownership is one of the ways that we build wealth in the United States, and we need to figure out the systemic issues and supports that we need to increase homeownership. We also need to think creatively about ways in which we can keep people in their homes. For our clients, many times, the most affordable home they have is the one that they're in. And it may need, there may be deferred maintenance because of, not having access to good credit, that we then need to think through creative policy solutions to be able to make sure that people have access to do the repairs they need so they can live in their home in a sustainable way. And there's been some creative things happening in Pennsylvania, like the whole home repairs bill that we just passed through the state legislature is going to provide some additional financing and capital so people can be able to stay in their homes, the homes that are affordable to them, and make the repairs that they can, so they can live in them for the long term. I think those are the kind of sort of creative approaches that we need to make sure that we're sustaining wealth in our communities.
Thank you, Kari. Mac, I know we're going to lose you relatively soon and invite any thoughts you have, but particularly around the issues that Kari just raised. So we have a new statewide program to help people preserve their homes. There are lots of rent to own programs or ideas, at least. You mentioned community land trusts. I would guess that many of the people on this Zoom are familiar, but many are probably not. So maybe you could educate us a little bit about those two. And the general framework of the question is, what are innovative ideas to help people stay in neighborhoods or get to neighborhoods where they can flourish?
Sure. So, the idea of community land trust is kind of predicated on the idea that a lot of the appreciation in homes, the price appreciation in homes, is actually in the land and not in the structure itself. And so the idea is, if you want to make a permanently affordable housing stock that's going to be available to, like workforce housing, if you can find land and then transact and keep the land in trust, right, held by the community and governed by the community, and then transact only in the improvements, the buildings themselves, right, then the buildings are a lot cheaper than buying the land, right? And so the other thing is that the community land trust, if you hold the land in trust, then it means that these institutional investors from Wall Street can't come in and buy up your housing stock because they want the land with it. Without the land, the housing stock isn't worth that much. And the idea is, what you do is you start to build an inventory of these units, this housing. It could be multifamily, it could be single family. The idea is you accumulate this inventory of properties. You put it in governance structure that's typically a nonprofit governance structure. You have people from the community sitting on the board making decisions about the investments that are going to be made in it. And then you sell the homes with a modest lease arrangement where the people lease the land under the homes. And then when they resell the homes, they resell it at to somebody of similar means that they were when they bought the home. So there's a restricted upside as well. But the idea is that it's a way for community to take control, and then it's a way for community to, in some ways, decide its own fate. So one of the more famous examples of this is the Dudley Street Neighborhood Initiative in Roxbury in Boston, which started almost 40 years ago. And they realized that the city wasn't going to come in and fix up their neighborhoods. So they decided that they were going to acquire it at very low value and then find ways to get investment capital from what used to, well, we didn't used to have ESG investors or impact investors, but you had, foundations and others who gave them working capital. And then they started to make the investments in the properties, and they acquired more and more properties so that now they have hundreds and hundreds of units of housing that are affordable and of high quality. And they also are able to bring in commercial services that serve those neighborhoods. So you don't have things like the food deserts that we know also exist in these low-income communities. Now, one of the critiques is that this isn't the kind of home ownership arrangement that builds gigantic amounts of wealth like we did in the United States between the Great Depression and the 1970s. But what it does do is it begins to stabilize communities. And the other thing it does is it provides a bridge for people who are renters to get into home ownership if they can't get there directly, right? Because they can find an affordable arrangement in which they can own and control their home. They can still invest in their home. They can stay there forever if they want. But what they can do is they can build egg that very often is enough to be a down for a home that they buy after the fact, right? So we have, about 250 land trusts around the country now that in different cities that are now beginning to organize themselves and network to begin to provide, find ways to get facilitative public investment and public action to make sure that they can continue to grow and to, in some ways protect a large enough share of the local housing stock that is available, and it won't be kind of scooped up by the investors, right? But just one other point about that, rent to own, contract for deed. There's a whole bunch of ways that people have been able to kind of circumvent a dysfunctional financing market to purchase homes. And the biggest problem with those instruments, which were very dominant, by the way, in the 1920s, 30s, 40s, before the housing finance system we have now got created, those are great instruments for people who behave in good faith. But the problem is, and I'm sure Carrie can talk about this, they're some of the easiest ways to abuse others. And so contract for deed in particular has been really abusive practice for getting people to think they're going to be buying a house on a contract and they miss one payment and they get evicted, right? And so all those kind of informal mechanisms for getting people into home ownership are ways that people had to circumvent a dysfunctional market, particularly ones that were structurally racist, right? Many of the people who use those mechanisms were people who wouldn't have access to high quality, decent financing. So the remedy for that is to make sure you get high quality, decent financing for people who want to buy homes, right? And I'm sure Jillian can comment on this, but if you own a home in an undervalued neighborhood, what are the chances that you're going to get a home equity loan to be able to invest in your home and bring it up to snuff, right? And one of the problems that we see today in neighborhoods is that more than 2.5 times as likely to live in substandard housing. That's not, I'm sure that statistic doesn't surprise anybody, but if that's the case, then we need to find a intervention that's going to make it possible for minority families to invest in their properties too, and at the best terms, and to be able to improve their neighborhoods without being displaced. So I'm sorry for the long answer, but that's where I am.
Wasn't that long an answer? It was very thoughtful. I have a couple more questions before we say goodbye, but I do want to invite Jillian or Carrie if you want to just kind of reflect on anything we're talking about now. If you want to go on, that's fine too. Okay, so I want to come back to something Mac mentioned earlier, and then something that all of us have talked about. So one question is, the question Mac asked is, how do we find more Jeremys? I'll broaden it out to how do we create more institutions that are focused on accessing and providing good capital, and how do we find leaders for those places? So I'm interested in your thoughts on that. And then the second question relatedly, it seems that one fundamental principle that underlies all of the things that you are doing is that the work has to be based in communities themselves, right? That if the focus is on extracting resources, we're never going to make progress. And the only way to actually protect communities and help them grow is to have decision making be at least partly at the community-based level. So I'm interested in your reflections on either one of those ideas. And then I'll just give you a preview. The final question I'm going to ask is how do, and people have asked this in the chat, how do we stay informed? How do people on Zoom stay informed about these issues and be more involved? But again, first, how do we create more institutions like Reinvestment Fund? And also, how do we build the partnerships, community-based partnerships that are necessary to produce equity? Big questions, I know. Give you a second to think about them.
All right, Wendell. I'll try to answer. How do we create more Jeremys? Okay, and so, one of the things about I'm an old guy. I've been in this business for way too long. But one of the things I've noticed as I've watched the evolution of the community development field is that the community development field actually started in community organizing. And it was organizers that actually moved communities, that created community development corporations and eventually created community development financial institutions, CDFIs, like the Reinvestment Fund. But what happened is over the years, we professionalized that industry. And so rather than having organizers now running these organizations, and Jeremy was a community organizer to start. I mean, he was a philosopher, but he was a community organizer, right? So what happened was we decided that we needed like MBAs to run our community organizations because they had to be run like businesses. And I have to say that, my former institution, the Ford Foundation, was one of the problems there because we kept driving those institutions to become kind of more businesslike and professional. And then they went on the MBA track. One of the things I like to say is that it's easier to teach a community organizer how to read a spreadsheet and how to do a pro forma than it is to train an MBA to be a community organizer. And so if you want to create more Jeremys, we have to elevate the role of community organizing and community organizers. And we've got to create a pipeline of people who are, kind of cultivated in that kind of mindset and in that realm, right? Like, by the way, Barack Obama, right? Who are able to then take those community organizing skills and the mission orientation and then build the other skills they need. Because Jeremy wasn't a banker or a lender when he started, but he got pretty good at it. And he got pretty good at it because he saw the need and he learned what he needed to do to add to his own, toolkit as he went through, the years and years of frustration trying to make communities work, right? So I think we need more community organizers getting out there and train new pipelines.
Thanks, Mac. I know Julian and Curry agree with you on that, but the question is, how do we do it? And then also, if you have any thoughts about how do we make sure that institutions actually stay connected to communities, something that we talk about at Reinvestment Fund on the board every day, because it is easy to get distracted.
Yeah, Wendell, I wanted to speak to how to get involved if somebody is interested in this topic and wants to stay connected. And I can answer that specifically for appraisals and appraisal bias. There's a foundation called the Appraisal Foundation. And on the Appraisal Foundation, there are two boards. There's the Appraisal Standards Board and the Appraiser Qualifications Board. The standards sets the guidebook and the rule set for appraisers and how what rules they have to abide by when completing reports. And the Qualifications Board makes a determination of who gets to become an appraiser. There is a reason why the appraisal industry is so homogenous, and it really stems from what it takes in order to enter into the field. And so one step towards addressing appraisal bias is to have more diverse voices attaching opinions of value to communities that hopefully that they are a part of. And so the Appraisal Foundation hosts exposure drafts and listening sessions with both the Appraisal Qualification Board and also the Appraisal Standards Board, where people are able to come and opine on the new rules that are going to be rolled out, which have far-reaching implications on all of us when it comes to mortgage financing. So anybody who's interested in getting involved, I highly recommend that as a first step. And you can go to the appraisalfoundation.org to get more information.
Thank you, Jillian, for explaining that. I also will put in a plug for another aspect of the work that you're doing. We'd love to have more appraisers of color. And it's a fascinating profession. So I don't know whether you want to share anything more before I go to Carrie about that, but why not take a chance to make a plug for your profession, please?
Absolutely. Happy to make a plug for it. So since I started in this work in terms of speaking about the disparities and bias within appraising, I've been overwhelmed by the number of people who come to me and ask, okay, how can I get started? How can I enter into the profession? Because they see so clearly how it is a way to support their communities. So just roughly, in order to become an appraiser, you have to take qualifying education, and then you have to enter into an apprenticeship with another appraiser. And the typical apprenticeship is anywhere from a year to 2 years, sometimes beyond. And so anybody who is interested, especially people of color who are interested in entering into the field, right now there's a very large push to diversify the industry. And so Fannie Mae, Freddie Mac, the National Urban League, and the Appraisal Institute have all come together to create something called the Appraiser Diversity Initiative. And pretty much it's a scholarship fund to pay for the qualifying education. But the best part of this program is that at the end of it, they will help pair you up with the supervisor. And it is at that point that most people of color get stuck in the pipeline, because appraising is a career path that is generally passed down through the generations from grandfather to father and father to son. And so the ADI program helps get people paired up so that they are able to go out there and start appraising. And then the end goal is for these appraisers to then train the next generation of appraisers. So anybody who is interested in becoming an appraiser, definitely check out the Appraiser Diversity Initiative. And then also one additional plug, while most appraisers focus on mortgage lending transactions, there are all types of reasons and needs for appraisers. So there's like real property appraisers, that's what I am, but there are also personal property appraisers, business valuation appraisers, equipment appraisers, there are divorce appraisals, tax certiorari appraisers. So there's a really a wide world that you enter into once you get into the valuation space.
Thank you, Jillian. Thank you for that important work. I want to give Carrie an opportunity to comment on, I think there are about 7 questions floating around right now. But before I do that, I also want to give a warning to our colleague, Don. We're going to turn to you in a second. And I think I can do that since technically I'm Don's boss as a board member. So Carrie.
I just wanted to really second and amplify the call for community organizers. At Community Legal Services, we take an approach to representing individuals that doesn't just involve direct representation, like filing and entering an appearance in a lawsuit or filing an action on behalf of a client. But when we see systemic issues that are impacting routinely clients over and over again, we're able to engage in systemic reforms, whether that be a class action lawsuit or figuring out a legislative solution. And I have found that some of the most creative lawyers in the legal services space have a community organizing background. They may have done advocacy work prior to going to law school, and having that kind of mindset of being like a strategic thinker about what are the problems our community are facing, what are the solutions, and what are the tactics and strategies that are going to get us to an end result, can just really create some just tremendous innovations. And then that all needs to be rooted deeply in the community. So thinking about community from legal aid perspective, thinking about a community lawyering perspective, not just simply setting up structures and having people come in who've, okay, you have a mortgage foreclosure problem, you're going to go to this unit, you have a housing problem, you're going to go to this unit, but actually doing deeper work out in the communities to where we have long-term relationships and can get more of a sense of the problems the community is facing. And then changing our practice and evolving to address those concerns is something that we need to continually be reminded to do and innovate in that area.
Thank you, Carrie, for all of that work. Don, I think your thoughts somewhat mirror what Carrie just laid out. I mean, we've had conversations around that kind of community engaged work, but I'm interested in your thoughts about any of the questions we're struggling with, but particularly how do we create more Jeremys? How do we build more CDFI capacity? How do we grow the kind of good work that's being done?
Thanks. I'm still recovering from being othered as having an MBA. But luckily, my MBA did not come from an Ivy institution, so I was much more grounded, having gone to Temple University. I think there is to create more Jeremys, you need to surround those Jeremys with the dedicated team that he had. And, that team that could implement his vision were really essential. So in that, there's who's going to be the IRA in terms of being really dedicated to advising public policy people and presenting them with wise analytics so that they can make data-advised decisions in policy. Where is the lender who is happy to drop out of the structurally racist banking industry and do some good? Where is the social worker / MBA who can design programs and bridge from our obligations around building capacity to financing that capacity? It is about team construction. And I think that's really the difference between CDFIs that have scaled and are broad versus those that have not. And it's really about that talent. And I think the next generation is very interested in this work and very well equipped. The missing pieces that we don't fund organizing. It is the hardest work of all, and it is the most underpaid work. And from it comes the anchor to being able to be a financial, the pressures around being a financial institution and the pressures to becoming sustainable. I went through that first Ford visit and almost had a hospitalization moment from the stress. There is a need to be a sustainable enterprise while also doing mission. And those two things at the same time are much harder than just being a nonprofit or just being a profit enterprise. Having both of them in your hands is very challenging. And I think that's what Jeremy was so gifted at, was he kept us anchored in a civil rights context throughout all of our work, and was able to reconnect us whenever he thought we were getting astray, right? That there were new people to be introduced to and new ambitions to have. I agree with Mac that, if only Mac were running a larger foundation so that we could fund community organizers all over the place. But that is a profession that's at risk right now. And I don't think it has, it needs new structures and new sponsorship. But it's from those community actions where you use people power that you realize that money power isn't as powerful as you thought. And it's only powerful when you connect it to people power and when you connect it to organized data. So organize the people, organize the data, and the organized money is the least heavy lift of those three things in many settings. So it's been a pleasure and not a crusade to run the reinvestment fund, because we had that great start. And I don't know where the next generation of this great start comes from. It's going to come from people connected to Occupy and BLM and other organizations who combine it with their other native talents and say, wait a minute, how can I use this in this way around building community assets or building community wealth in the next phase of their activism. But we desperately need people to get involved with and to fund community organizers. That's the wind, that lets the jet fly.
Thank you, Don, for that thoughtful answer. It is a big challenge, but it also is very meaningful work. And I hope that we can, maybe even on this call, motivate the next Jeremy, the next Don, the next Jillian, the next Curry, the next Mac. And so with that, I want to thank Curry and Jillian and Mac for your time, for your engagement, for the hard work that you do every day. And I want to thank everybody for joining this Zoom on behalf of Penn IUR and Reinvestment Fund. And we look forward to engaging with all of you in the future. Thank you, everybody.
Thanks.